The SGH Australian Small Companies Fund outperformed the benchmark by 2.5% net of fees over the September quarter. The fund delivered net returns of 9%, I should say, outperforming the Small Ords Accumulation Index, which delivered returns of 6.5%. Now, many of you would have heard us speak in the past about our barbell approach to portfolio construction, where we've got high quality, high growth stocks on one end of the barbell, which is balanced by more mature, more defensive companies on the other end of the barbell. Now, the September quarter actually saw both ends of this barbell perform very well. On the high quality, high growth end of the barbell, we saw a resurgence in risk appetite in the market mainly off the back of this really larger than expected 50 basis points cut in US cash rates. This benefited this group of stocks, and within that category, our portfolio benefited from holdings such as ProMedicus, which announced a very strong set of results for the fiscal 24 year, but that was further supported by a very robust pipeline of future potential contract wins. Hub24 and Pinnacle Investment Management are two other stocks I'll put in that category, which have done very well off the back of positive market sort of inflow environment, but also the fact that these businesses have high fixed costs and so very strong operating leverage when things are going well. On the other end of the spectrum, when we talk about more mature and defensive businesses, that end of the barbell, we also did fairly well over the September quarter down there. There's been a broadening out in the market, which has resulted in some of these underpriced stocks and those that offer defensive attributes perform quite well. In our portfolio, one of the standouts is the New Zealand Stock Exchange. So it's a holding that we've held for quite a while, but we're starting to see the market gradually reward the company for the upside potential within their emerging wealth tech business. Now, that business they've been working on for a number of years. However, it's grown its revenues, and it's approaching that sort of free cash flow break-even point, which is often a milestone that is closely looked at by market participants. The two other companies in that sort of more mature category, I would say, is fund manager Centuria Capital, as well as residential developer Cedar Properties. Those two companies also performed very well in the September quarter, with the prospect of future interest rate cuts obviously helping transactional activity, but also to that point, really combined with the very low starting valuations, resulted in some mean reversion, which benefited some of these names. One clear area of opportunity for us at the moment is in the REITs. We believe that some of the headwinds that have engulfed this sector in recent times are starting to abate, and in some cases will turn to tailwinds in due course. The REITs have faced a number of significant headwinds from rapidly rising interest rates. Central to this was higher interest servicing costs on their borrowings. This has resulted in reduced free cash flows and, in many cases, cuts to distributions. Now, through the most recent reporting season, we've seen many REITs reset their effective interest costs to market rates. This removes some of the potential future headwinds to distribution growth, and we view this as a positive. Additionally, cap rate expansion appears to be peaking. This signals to us a potential trough in asset values. There's also increasing evidence of stronger property transaction activity, combined with the potential for future interest rate cuts. We remain positive on the outlook for the REITs and for equity returns available in that space. From our portfolio, what we have done is we've moved from a slightly underweight position in REITs to slightly overweight position. If I now turn to the risks that we see in the marketplace, well, we are pretty constructive on the outlook for markets. I guess one of the key risks that we continue to monitor is the potential for a sharper economic slowdown, particularly against what the market is pricing in. Well, I stress that this isn't our base case, but we are cognizant that traditional economic indicators are weakening, with labor market softening also following pretty closely. Rising tensions in the Middle East is another area of risk, and that we monitor quite closely, as is the potential for policy destabilization, depending on which way the November US election falls, particularly around tariffs. That's an area that we're monitoring quite closely. There are offsets to some of this risk, as we've seen in recent times with stimulatory activity from the Chinese in recent weeks, as well as the fact that global central banks are just starting to exercise their put options in terms of monetary policy. The combination of these factors, however, will I think create some ongoing market volatility. As a result, what we are doing from a portfolio perspective is we're keeping a fairly balanced approach to portfolio construction, a fairly balanced barbell, if you like, and that will allow us to maintain sufficient insurance in the portfolio and to ensure the capital preservation in the event of fat tail risk emerges. Returns for small companies have significantly lagged large caps, particularly over the last 3 years. In fact, when you look at the small odds over the last 3 years versus the ASX 100, small odds has actually underperformed by more than 30% cumulatively. However, we believe that we're approaching an inflection point, and the outlook for small companies is brightening significantly. In our minds, there are three key reasons to be more optimistic on small caps. The first one is interest rates. So the interest rate cycle globally appears to have peaked, and with the onset of an easing cycle, we think that's likely to benefit small caps more than large caps. And there are a few reasons for this. Small caps are more able to capture the corresponding sort of stimulatory activity that comes with a cutting cycle. Given they're small in size, they're a little bit more agile and nimble in nature. Furthermore, in many cases, small companies compared to large companies have lower levels of fixed debt, which means that as interest rates come down, their interest bill also comes down more quickly. The second reason why we're optimistic around small company performance is there's increasing evidence that the concentration in markets that we've seen in the last 12 to 18 months is starting to broaden out. We've started to see this offshore with the Russell 2000, the US sort of proxy for small companies, actually outperforming the broader cap index. And we've seen that domestically in our market here in September as well, with small caps significantly outperforming sort of the benchmark ASX 200. What we think will happen is that you will see a similar broadening out in the domestic sort of market here, and mean reversion in performance, in relative performance from small caps will start to come true and start to fill that sort of vacuum of liquidity, I guess, that we've seen at the small end of town over the last 2 or 3 years. Now, the final reason why we're positive on the outlook for small companies is really about one of the indicators that we're monitoring, and that's IPOs and secondary market activity. Well, the IPO markets remain fairly soft, I would say, and there's been fair few number of transactions. What we're seeing over the last, I think, 8 to 10 weeks is really a return in secondary market activity. So boards are more willing to greenlight M&A transactions. We've seen that flow through in terms of companies coming to market and tapping equity markets for secondary capital. Most of those deals have been very well supported by the market and have led to pretty strong aftermarket trading. We think that's a pretty positive indicator that there's additional liquidity will also come back into the small cap space. And that should result in, again, closing some of that relative underperformance gap.